Every month, you wait for rates to drop below 5%. Costs you roughly $400 in extra interest payments. That is the number nobody puts in the headline. Not the lender, not the real estate agent, not the financial media telling you to hold on just a little longer. $400 a month on a standard $400,000 mortgage at 7% versus 6.2%. Real money. Every single month. Going nowhere. And 4 in 5 home buyers are doing exactly this, waiting. A U.S. News survey from March 2025 found that 80% of buyers and refinancers are sitting on the sidelines, holding out for rates to fall. 45% of them have a specific target in mind. They want rates below 5% before they move. Here's the problem. The forecasters who actually model this for a living are not seeing 5% anywhere on their charts for the next several years. And the gap between what people are waiting for and what the data says is coming, that gap has a price tag, a very specific one. Today we are going to run both sides of this math honestly. The case for refinancing now, the case for waiting, and a third path that most people never hear about because it does not generate a commission for anyone. The answer is not the same for every household, but the framework for finding your answer is the same for everyone, and that is what we are building today. This is Sarah's Money Map. If you want financial decisions built on real numbers rather than headlines, subscribe. It is the only return on investment in this video that does not require a closing disclosure. Now let us start with what the forecasters are actually saying, because this is where the rate mirage begins. The rate mirage is the belief that sub 5% mortgage rates are coming soon. It feels reasonable. Rates were below 5% as recently as early 2022. Inflation has cooled. The Fed has cut. The logic seems sound. But here's what the institutions doing the actual modeling are projecting. The Mortgage Bankers Association forecasts an average of 6.4% for 2026, then 6.4% again for 2027, then a slight tick up to 6.5% in 2028. Fannie Mae is slightly more optimistic, 6% in 2026, 5.9% in 2027. The most bullish mainstream forecast sitting around 6% over the next 2 years. Now think about what that means. If you are waiting for 5%, you are waiting for something that every major forecasting institution says is 3 to 5 years away at minimum, and that assumes no new inflationary shocks, no labor market surprises, no geopolitical disruptions. Goldman Sachs analysts have modeled the 10-year Treasury yield rising to 4.5% by 2035. Mortgage rates historically run 1.5 to 2.5 points above that benchmark. Do that math and you are looking at rates above 6% for most of the next decade. The rate mirage does not mean rates will never fall. It means the timeline most people are operating on, 6 months, maybe a year, does not match the data. And when your timeline is wrong, the decision built on that timeline is also wrong. Let me show you what waiting actually costs. This is what I call the waiting cost. Imagine a single bar. That bar is the interest you pay on your current mortgage every month. If you bought or refinanced in 2022 or 2023 at 7% on a $400,000 balance, your monthly interest component alone is roughly $2,300 in year one. The principal portion of your payment is about $650. Total payment around $2,950. Now refinance today. Current Freddie Mac data from the week of April 23rd puts the 30-year fixed at 6.23%. On the same $400,000 balance, your new monthly payment comes to around $2,460. You just saved approximately $490 a month. The bar just shrank. Here is the waiting cost. Every month you do not refinance, assuming you qualify and your current rate is at 7% or above, you are spending $490 that you will never get back. That is not a projection. That is arithmetic on today's rate environment. 12 months of waiting, roughly $5,900. 24 months, nearly $12,000. 3 years of waiting for sub 5%, while forecasts show 6+ through 2028 costs you somewhere between $18,000 and $22,000 in excess interest payments alone before you ever see the rate you are waiting for. You might be thinking, but what about closing costs? That is exactly the right question, and it is the most important number in this entire decision. The average closing costs on a refinance run 2 to 5% of the loan amount. On a $400,000 balance, that is $8,000 to $20,000. Let us use a realistic midpoint of $6,000, which reflects a streamlined refinance with moderate lender fees. Your break-even calculation is simple. Take your closing costs, divide by your monthly savings. $6,000 divided by $490 equals approximately 12 months. In just over 1 year, the refinance pays for itself. Every month after that is pure savings. If you plan to stay in your home for at least 2 years, which is the case for the vast majority of homeowners, the math on refinancing now is favorable. The waiting cost accumulates. The break-even gets crossed, and then you are ahead. But I told you we were running both sides honestly. So here is the strongest case for waiting, and it is real. If you are planning to sell within 18 months, closing costs may not recoup. If you bought recently at 6.5% and current rates are 6.2%, the monthly savings are too small to justify $6,000 of upfront costs. If your credit profile has changed or your equity position is weak, you may not qualify for the best rates available. And if rates do somehow break below 6% faster than forecasters project, due to a recession, a major Fed pivot, a labor market collapse, then waiting could have been right. The case for waiting is not irrational. It is a legitimate position under specific conditions. The problem is that most people waiting are not waiting because they have run these conditions against their own situation. They are waiting because they heard rates might drop and that felt like a reason to pause. That is a feeling, not a framework. Here is the synthesis that most lenders will not tell you because it does not fit neatly into a sales conversation. Refinancing is not a binary choice between refinancing now at this rate and waiting indefinitely for 5%. There is a third category that sits between them, the no-cost refinance. In a no-cost structure, the lender covers your closing costs in exchange for a slightly higher interest rate, typically 25 to 50 basis points above the market rate. If current rates are 6.23%, a no-cost refinance might price at 6.5 or 6.75. Your monthly savings are smaller, but your break-even is day one. You pay nothing out of pocket. For homeowners who are not certain they will stay long enough to recoup traditional closing costs, the no-cost option removes the risk entirely. You capture some of the benefit now without committing $6,000 to a timeline you are not sure of. And critically, if rates do drop to 5.5% or 5% in 2 or 3 years, you can refinance again with no sunk cost from this round. The rate and term refinance is for homeowners confident in their stay timeline with meaningful rate gaps to capture. The no-cost refinance is for homeowners with uncertainty about timeline or a smaller rate differential. The cash-out refinance is a separate decision entirely. Accessing equity carries its own logic and its own risks, and that is a different video. Now, I want to address one more layer here, because this is where most refinance conversations stop too early. 45% of people in that survey said they are waiting for below 5%. If you are in that group, I want you to run one specific calculation before you continue waiting. Take the number of months until you believe rates will hit 5%. Multiply that by your monthly waiting cost, the gap between your current payment and what you would pay at today's rate. That is the cash price of your forecast. If you believe 5% rise in 24 months, and your waiting cost is $490 per month, you are betting $11,700 on that forecast being right, not on rates falling. On rates falling to that specific level within that specific window. Mortgage Bankers Association, Fannie Mae, and Goldman Sachs all say that forecast is unlikely to be accurate. You may still be right. Forecasters are not always right, but you should know what you are betting. And you should bet it consciously, not by default because the decision felt too complicated to make. Here's the protocol. 3 steps. Step 1 is to calculate your current rate versus today's best available rate. If the gap is less than half a percentage point, the standard refinance math likely does not pencil out unless your loan balance is very high. If the gap is 1% or more, run the full calculation. Step 2 is to calculate your break-even. Take realistic closing costs for your market and loan size. Divide by your monthly payment savings. If your break-even is shorter than your expected remaining time in the home, refinancing now is the mathematically favored path. Step 3 is to price a no-cost option if you are uncertain about your timeline. Ask your lender specifically for a no-cost rate quote alongside the standard quote. Compare the long-term cost of the slightly higher rate against the certainty of zero upfront exposure. That comparison tells you which structure fits your situation. That is the decision tree. It is not about rates. It is about your numbers, your timeline, and your tolerance for the waiting cost. For $90 a month, 12 months of waiting, nearly $6,000. That is not a rate. That is the decision. The rate mirage is powerful because it is partially true. Rates will eventually fall, but eventually is not a financial plan. And partially true is not the same as actionable. The waiting cost is running right now in your account, whether you have done this math or not. Drop your break-even number in the comments. No need to share your full situation, just the month count. It helps everyone in this audience see where the real range sits. And if you found this breakdown useful, hit the like button. I will see you in the next one. Not financial advice. This video is made for educational and entertainment purposes only. Please do your own research. Some voice or visual elements may be AI assisted, with final review and editing by me, Sarah.